Good morning, happy Monday, and welcome back to another edition of Accessible Alpha's Market Update, this time for the week beginning October 28th. Happy Halloween week. And first of all, I want to apologize for not getting a video out last week. I thought I could Iron Man it, and even though I was traveling, I thought I could get a video out, and I did not. So thank you for your patience. I thought about making this a double episode. I pretty much do that anyway. I say I'm going to keep it to 15 minutes and it's always longer. So I'm really just going to cover last week. But if you have any questions about the week previous, leave them in the comments on YouTube or join our Discord. The link is in the description of the YouTube video. We'd be happy to have you. So before we begin, as always, please keep in mind that anything I discuss in this video or on the podcast is for informational and educational purposes only. Please do not take it as investment advice. It is not intended as such. Hopefully you can learn a thing or two. Hopefully I can bring you into my process, but this is certainly not investment advice in any way. All right, let's jump into some market news. So kind of a busy week on the economic news side of things, and this is really important because in the equity markets, which is typically what I pay attention to, the market really responded to the economic news that came out. So I think it's very important to cover. So this I did cover from the past couple weeks, but basically retail sales were up about 0.4% in September. Just to provide some context, I went back from 1992 to present day. I got rid of recessionary months, but I wanted to look back and see what is the monthly average of retail sales in our market for, like I said, all those months that are not recessionary months, which are clearly just a different economic situation, and it's about 0.4%, a positive 0.4%. So about the mean there in September for retail sales, and that basically means that folks are still buying things. That's really healthy. Durable goods sales, on the other hand, were down 0.8%. They were down for September, but also for August as well. So 2 months in a row, down 0.8%. Again, I did the same exercise going from 1992 all the way to present day, getting rid of the recessionary months. Come to find out, the mean monthly increase in durable goods sales is about 0.4%. This is what the market reacted to on Friday. We saw a bit of a sell-off on Friday. The reason being, and I wanted to explain this, is that durable goods are basically goods that are consumers purchase, but they're much larger. Think appliances, things you're going to have for a long time. And because they're much larger, you typically need to finance them. The economy is doing well when folks are willing to not only spend money, but spend money with credit. And because durable goods sales are down, basically the market inferred that we're not quite sure what the spending habits of consumers are. So that one's an interesting one. We want to pay attention to that in the future. Again, it's just one data point out of many that come out. However, the market certainly reacted to it, especially as we think about the election coming up and the volatility that usually arises in equity markets with elections, but something to pay attention to for the future for durable goods sales. In terms of the homes front, new residential home sales were up 4.1% and housing starts were down just a little bit, 0.8%. Again, I pay attention to this because, like durable goods, how folks think about homes and purchasing either new homes or existing homes is a good proxy for what their appetite is for spending money, and clearly using credit to do so, which is a great economic indicator. Really, the story last week were bond yields were up even though rates are falling, and that's putting a damper on equity gains. So what the heck does this mean? Because you're going to read this a lot, bond yields, bond yields, bond yields. Let me explain this quickly, as quickly as I can. Basically what happens here is that if we think about stock prices go up when demand goes up, right? If Nvidia is hot, everybody wants an Nvidia because their earnings either now or in the future are supposed to be higher. People will buy Nvidia, that drives the price up. In a way, bonds are kind of the opposite. So what happens is a yield is the overall return you're going to get on a bond. but the yield is higher when the price is lower. And that's because there's a fixed rate called the coupon that the bond has to spit off. So if a bond is trading at $100, let's say the coupon is 5%, you're going to get $5 per year of interest on that bond. But if the bond is out of vogue, right, the price is falling, that means you're going to get a 5% coupon maybe for $90 of that bond, and it means the yield actually goes up. This is a little bit interesting because even though rates are falling, which typically means yields are going to come down, we're seeing yields go up even though rates are falling. I know this is a bit confusing. I wanted to cover it at least at a high level, but what we can think about it from the equity market standpoint is that folks are still a bit undecided on what's going on with the equity markets. That could certainly play into the election and why that dynamic is happening in markets, because elections typically are extremely volatile. Maybe folks are just navigating away from equities and wanting a more safe investment in bonds. But in reading a bit about this as well, because I was curious, it seems like the market believes that yields cannot really go up any more than they currently are. So there's a bit of a spike in yield, but as the yield goes up, people will buy the bond increases in price, then the yield comes down, and there's this bit of equilibrium that happens. A lot of folks are believing that that point is upon us. So we'll kind of see what happens there. Lastly, from an economic standpoint, because again, the real summary of this slide this week is most of the economic indicators are really good. We see retail sales are up, we see unemployment coming down, we see inflation coming down clearly. It seems like we're in a great spot, but there is this rule called the SOM rule, basically written by an economist in 2019. This was triggered in July, and the SOM rule basically is a real-time recession indicator. There is no official definition of a recession. Typically, we use 2 quarters of negative GDP growth as kind of how we generalize the definition of a recession. But the SAM rule is basically saying you look at unemployment in real time, you take a 3-month moving average, you get a value, and if there is the current 3-month moving average value of unemployment is 50 basis points higher than any SAM rule value in the past 12 months, this seemingly indicates a real-time recession. It was triggered in July. Clearly, we didn't have a recession in July, so there are some false positives here. But it basically goes to show that there's a lot of great economic information that's coming out, but there's also still some sideways ones or some negative ones. The SAM rule being one, the inverted yield curve, which I believe I spoke about 2 weeks ago, is another one. Again, I don't think we're exactly inverted on the yield curve, but we certainly are flat. And if you're curious on getting more detail on that, just watch the video from a couple weeks ago. So point being of the slide economically is that yes, we're heading into an election. That's going to provide uncertainty in the markets. Typically when there's uncertainty, people will move to fixed income. Maybe that's what's driving up the increase in yields, but as you have an increase in yields, the bond price is going to go up, bringing yields down, and then maybe folks will come back to the equity market. We'll have to wait and see, but as I've been saying for the past bunch of weeks, it just seems like a bunch of mixed information out there, but for the most part, things are pretty bullish. For company news, I've already spoken a lot on this slide, and again, I'm trying not to go too far over on time, but the most confusing stock in the world for me in the equity market continues to be the most confusing stock in the world for me. Tesla is up almost 22% last week on news of delivery growth in 2025. They say about 30% increase in delivery growth in 2025. I mean, I took a bunch of notes here on Tesla given their third quarter earnings call. It's unbelievably confusing. Really what's happening here is that the margins of Tesla have continued to fall for years now. So remember, the margins are how much you sell a car for relative to how much it costs to make the car. That delta is called your margin. It was about 14,000 in Q3 of 2021, and now it's less than 6,000. It was less than 6,000 in Q2 of 2022. So it's about a 60% decline in margin. Yet, in Q3, that margin increased a little bit. I think it was like $6,200 or something like that. And basically the market loved it. So not only are they shipping more cars, but the margin is up a little bit. clearly you can increase your margin by just cutting cost, by operational cost, OPEX. You can cut that, increase your margin a little bit. I personally believe that's kind of what Tesla is doing, and that's a really near-run Band-Aid on potentially a larger problem here. So I'm not completely convinced that they can scale their business by building these low-margin vehicles, but making it up with scale. We'll have to wait and see. For the sake of time, I mean, I wrote down a bunch of notes here, but it just doesn't seem like it's something that's very scalable. Maybe I'm wrong. It's not a stock that I'm in, unfortunately. Again, maybe I should have been last week, up 22%, but it just seems like it's far too volatile. And the volatility is really a function of news and not necessarily a stable, scalable business. So we'll have to wait and see there. And then from the earnings standpoint, we're right in the middle of earnings season, clearly for Q3. They're a mixed bag so far. I ran back and did a bit of analysis in October. So 70% of the firms have beaten their EPS estimates in October, which is clearly a very good sign, but only 35% have had positive returns in that time. So yes, it seems like firms are posting, EPS that was better than guidance. Maybe that's because the economy is a bit more healthy than we potentially pessimistically thought as analysts. But there's only 35% of those firms. There were 611 firms in the research that I did. Only 35% of those have positive returns in that time. And given the seemingly strong, market that we've been in lately, it's just a bit odd. And again, to me, it just gets back to the market is still a bit undecided on exactly what's going on, but it certainly has a bullish tendency to it. So we'll have to wait and see, but that's it for economic and company news for this week. All right, let's flip over to the indexes for last week. These are the three main indexes that not only I look at, but surely most investors are equity investors as well. S&P 500 on the top, NASDAQ in the middle, and the Dow Jones on the bottom. Basically what we saw for last week was kind of a mixed bag, which my school of thought is that's typically not a good sign, but this has to persist for quite a while. 1 week is surely not enough to cause too much alarm. But basically last week, the S&P slipped about 1%. The Dow Jones slid almost 2.7%, which was quite a bit. But the NASDAQ was actually up about 0.2%. So when we see a bit of divergence in the indexes, that typically is an alarming sign because it means the markets are not in sync. I'm willing to let that go a little bit because of two things. The first is the election. We're clearly coming up on an election. Every time we do, historically speaking, there is certainly a lot of volatility, and there could be volatility clearly kind of intra-market as well, meaning maybe tech is a bit more in favor, and maybe some of the staples as represented by the Dow are not. Maybe that's what we're seeing. The second thing we're seeing is, again, we're at market highs here. Clearly at the S&P we're at market highs. NASDAQ we're almost to highs from that July number, and then on the Dow Jones, we're almost, we are back at highs, but we just kind of dipped last week. And when we're at highs, it does take a lot of conviction in the market to burst through there. So with the headwinds from the election, and at least the volatility there, I'm kind of willing to let that go. But as a trader, you do want to take a look at the indexes to make sure that they are well aligned. And if they're not over a long period of time, it usually is a good idea to reduce your exposure to the market in general. So we'll have to wait and see what's happening there. But, with the election, let's get through that. Let's get through the volatility. Let's get on the other side. And then we'll have a better view of, really what's happening with the indexes. A third part I would bring up to you is obviously we're in the middle of earnings season as well. So we kind of have these three different pieces coming together, being at highs, having the election, and then right in the middle of earnings season, it's going to cause some volatility. And there could be a world in which maybe firms on the NASDAQ do better in earnings than other firms, and because of the concentration of the NASDAQ, you could see better performance. I mean, look what happened with Tesla, who's a NASDAQ company. Maybe that's explaining it as well. It is good that we are at highs, and then maybe we can jump off from there. But we'll have to wait and see, and getting through the election is going to be a critical part of that. All right, so heading over to winners and losers for last week. A couple of funny ones here, but I laugh because I'm more of a fundamental manager at heart. Technically, I'm quantamental because yes, I use fundamentals in my kind of selection and filtering, but then I use a lot of technical analysis in terms of when I buy and sell securities and for how long I hold them. But we can't discount price movement. So the first on the winners group was DJT, the Trump media company. And this was up quite a bit last week. I mean, quite frankly, it's been up since September 24th. We see down here at $12. Now we're at $39. I mean, that is a 218% increase. Again, the fundamentals of this firm are not great in a million different ways, but we can't argue with price action. So it's not a chart that fits my eye necessarily, but we certainly have to call it out. With Trump being a clearly major candidate in the election, I think this is very election dependent. But if you were able to get in kind of at the low down there and be able to hold on, I mean, good for you. That is clearly quite a great return so far. The second, we already mentioned about some of the whys of what happened with Tesla last week, but Tesla up about 22% last week. Clearly you can see here that they've gapped up on earnings. They were able to surprise from an EPS standpoint, not a revenue standpoint. I've said multiple times, this is a very confusing stock for me from a fundamental standpoint, but I think what is interesting here for me is that we are now back at this kind of high point, this point of resistance here. And if Tesla can blow through this, kind of 270 level and have some momentum in doing so towards the end of the year, especially with what they're announcing and purporting as an increase in deliveries for 2025, that could be an interesting position to hold. It is an extremely volatile stock though, so you do have to think about who you are as a trader and who you are as an investor, and if you're willing to hold on to that volatility in your portfolio. But if you are, it at least is now at a pretty interesting level, and we'll have to kind of see what happens with that. The third stock I wanted to bring up from a winner standpoint is the Greenbrier. And this one is a bit more traditional in the sense of the fundamentals are actually really strong. It's had really strong growth, EPS growth going back to really 2021. So especially as the world kind of, exited COVID. And by the way, Greenbrier they supply transportation equipment to the railroad industry. So as the economy frees up, more and more firms are going to need to get their wares around. Companies like the Greenbrier, as long as they are run appropriately, which surely they seems like they are, they're going to do better and better as the economy improves and frees up. And as you can see in earnings, they were able to surprise from an EPS standpoint over 37%, and they were basically on target, a bit of a surprise on revenue. But the idea here is that they gapped up quite a bit, and because they're at highs, that is also something that's really interesting. They were basically, had that resistance level at around 55. They were able to blow through that. They were able to blow through that with some good volume down here, and that typically means that a stock is kind of in vogue now. So it could be a good position to get in, especially as the economy is leaning more towards freeing up as time goes on. From the loser standpoint, I actually just highlighted the first 6 or so losers in my universe that I look at. That universe is typically firms over $300 million in market cap listed on either the New York Stock Exchange or the NASDAQ, and they have to be American companies, no ADRs or anything like that. The reason why I wanted to highlight 6 of these, I'm not going to cover these in detail, but basically, it goes to show what a miss on earnings can do to a stock. So all of these, you will notice they announced earnings last week and they really took a bath. So, each one of these, you can see they've all gapped down. And the reason why I wanted to highlight this is that it does come up in trading conversations, do traders trade earnings? It certainly depends on your time frame, but I certainly know traders who trade on the shorter time frame. So think they're holding things for a day, days, maybe weeks. They will actually not trade during earnings. And the reasoning behind that is that you can have these huge gap downs. And if you have a huge gap down, like let's just look at, Mohawk, for example. If we gap down, 14%, and remember that earnings come out either before the bell or after, so you can't get in or out of these positions. You're kind of stuck with them. That could wreak havoc on a portfolio. That said, the other side of the coin, and this is actually where I fall, about 50% of a stock's returns come from its earnings. So you clearly need to diversify a little bit more. You need to hold in longer time periods. But if you do so, and if you pick firms that are fundamentally strong, you can actually see these gap ups. And the gap ups, like we saw with Tesla, even though that's a volatile stock, but if you had a more stable growth stock and you had a gap up on earnings, historically speaking, about 50% of a stock's returns come from its earnings. So I want to highlight these losers just so you can think about, do you want to hold stocks through earnings? If you're on the shorter time frame, it may be valuable not to do so. If you're on the longer time frame and you have a fundamental bend to your trading, it may be profitable to do so. So just something to think about there, but certainly wanted to highlight it. All right, let's move over to industry rotations. Now, I haven't done this in a bunch of weeks. The reason why is that it does take time for industries to kind of move, into favor and out of favor. So highlighting them every week may not be a service, but because I haven't covered it in about a month, I certainly wanted to visit it again. Please remember that at least in my point of view, which may not be correct, but it served me well. If you are looking at stocks that are in industries that are in vogue in the market, I call it price resiliency, but it's basically the idea of because people want it, the price will tend to move in a pretty stable direction. Not, it's not going to be a straight line up or anything like that, but at least provide some grounding towards the price. So if everyone wants a NVIDIA, for example, and I know I always use that example, but if semiconductors are in and you can get in on NVIDIA, it's really hard for that price to go down because everybody wants it. Remember, markets are a function of supply and demand. So if you're interested in a stock, even if it's fundamentally sound, if it's in an industry that's not doing too well, in my opinion, the price resiliency of that security is a bit compromised, and it may be something to think about. So let's look at the industry rotations. And you can see, even from a bunch of weeks ago, it's relatively the same, but there are a few new ones. So moving up, for those on the podcast, we have telecom infrastructure, financial services, investment banks and brokers, real estate development operation companies, specialty retail, movies and related products, electrical contracting, and regional banks. When I look at industries, I am certainly looking for themes. So themes, for example, I look at telecom, real estate, development operations, electrical contracting, regional banks. These are kind of durable. We used that term earlier in the podcast or on the video, but larger projects, larger construction projects, if firms that are backing these things, if folks in companies are willing to spend money on these things, and clearly the earnings are there for the firms, thus the demand for the stock, that is a pretty bullish signal. If I'm seeing more defensive securities in there, that leads me to believe that the economy is not too sure, that they want to be in a kind of an aggressive growth mode, but seeing things like telecom, real estate, electrical contracting, and regional banks clearly is a good thing. To really emphasize that point, seeing financial service, specialty retail, movies, these are clearly discretionary industry groups, and that means that folks are willing to spend money. We are seeing that on the macro side with advanced retail sales being up month over month, which is a great sign, but now we're seeing that in the industry rotation side as well. It means folks are willing to spend money. It means those firms are in vogue. It means those firms are in vogue because their earnings are high. These are good things. On the moving down side of things, we have non-alcoholic beverages, shipping companies, pollution control, which I thought was kind of a fun one, but pretty esoteric, but we throw it in there anyway. Containers and packaging, aerospace, auto retail, insurance, and consumer electronics. Again, I look for themes. There's not a whole lot of thematic behavior here. But what's happening on the moving up side of things clearly is, and that gives me enough confidence to say that we're certainly moving in a bullish direction in the equity market. So I probably won't cover these every week moving forward. Maybe I will every 3 weeks or a month or something like that. But clearly with what we're seeing here, the themes that I'm seeing, it shows a pretty bullish outlook on the market. So we'll have to wait and see, but so far so good. All right, for next week. Really important week, quite frankly. So both from an earnings standpoint, but also from an economic standpoint. So first, 5 of the Magnificent 7 firms are going to announce earnings next week. This is really important because those 5 firms make up almost a quarter, over 23% of the S&P 500's market capitalization alone. That's enormous. So only 5 firms announcing their earnings, and if those earnings are positive, that could clearly indicate and drive, bullish sentiment in the market. So we'll have to wait and see what happens there, but I'm really interested to see how the market responds to that. From an economic standpoint, again, very busy week. I highlighted on the slide the reports that I think are important, and then I'm only going to speak to the bolded ones. So there are even more reports that are coming out, but these are the ones that I'm certainly paying attention to. The first, consumer confidence. We were speaking a little bit earlier in the show around advanced retail sales being up, but durables, being down for the past couple months. Consumer confidence to me is something that is really important because it basically says how the consumers feel about the economy. Are they confident that they're making enough money to buy things, which is clearly good for equity markets, and this is an important report that reflects that. On Wednesday, we have the Q3 GDP advance estimate coming out. Again, earlier in the show, we were talking about how there is no official definition of a recession, but typically we define a recession as 2 quarters of negative GDP growth. We're nowhere even close to that. Right now, we have about 3% of GDP growth, which is extremely, strong, clearly. But getting that number locked in is clearly a good thing, and it can kind of be a good backdrop for the bull run that we've been on, but sustaining that bull run. Again, we're about 2 years into a bull run. Bull runs typically last about 4 years, 5 years, something like that. But we are at this kind of pivotal inflection point where if the economy remains strong as it has, that's obviously good for kind of long-only equity trades. So that's really what I'm interested in and really interested in that report. And then again, from the mortgage applications index side of things and home sales, we were speaking a bit earlier in the show about the durable goods side of things. I am not only concerned with the discretionary side, like retail sales, but also the durable goods side, big, large purchases that require financing with credit. Home sales are clearly that. If folks are willing to buy homes, if the demand is there for homes, that is a good sign for our economy. So those reports are always really interesting to me. On Thursday, we got PCE coming out. Remember, PCE is actually what the Fed uses to gauge inflation. So we'll have to take a look at what that means. And then on Friday, we have 3 critical reports: non-farm payrolls, unemployment rate, and the ISM manufacturing index. Non-farm payrolls, quite obviously, are just wages in the economy, and we really care about, how healthy the supply of money to consumers is. So we'll have to see what happens there. But that's been trending in a pretty positive direction. Unemployment rate, I think right now is at like 4.2, 4.3%. We'll have to see what happens with that. We were speaking about the SOM rule a little bit earlier. But if that comes down, that's obviously a very good sign as well. And then the ISM index is more of a kind of supply side of how businesses are feeling about their operations and how they're supplying the economy. So we'll have to wait and see on that as well. But all 3 of those are very important for a general economic indicator. Lastly, I did want to highlight the CME FedWatch tool. Right now, it says there's about a 95% probability of a 25 basis point rate cut at the November 7th meeting. Remember, we have 2 meetings left, one in November, one in December. But what's interesting about this is, remember, at the beginning of the year, we were talking about multiple rate cuts, 5, 6 rate cuts. We've only received one in September. Granted, it was bigger. It was 50 bips instead of 25 bips. But even right after that mid-September rate cut, the market was pricing in either 2 25 bip rate cuts, one in November, one in December, or just one large one at one of the 2 meetings. Right now, there's a 95% probability of only one 25 bip cut. And in fact, the no cut probability has been increasing in probability. So what does this mean? It really means that 2 things. First, Jerome Powell was the first to say, we're going to go, was it lower for longer? We're going to keep things really steady. We're not going to be aggressively cutting rates. But what that also means is that it kind of provides this sense in the economy that investors may have to find returns elsewhere. Maybe that's why we're seeing yields increase in fixed income. Yields will increase in fixed income because the interest rates in fixed income aren't going to change, right? So if we know that they're not going to change, or we think they're not going to change, I'll put it that way, then you are going to buy bonds with higher yields because the price is lower right now, but as you buy them, the demand for the bond is going to increase, the price is going to go up, yields are going to come down, and eventually when that equilibrates, maybe we jump back into equities. If rates actually do come down, basically you're going to have the same sort of dynamic in a way because you want to lock in the coupon rate that you're getting on fixed income now because in the future the rates are going to be less. You're going to want to increase what's called the duration of your fixed income portfolio by buying longer term, higher yield coupon, fixed income securities today. So this is really important for clearly fixed income traders, which I am not, but it's really important for equity traders because we're always thinking about opportunity costs. If fixed income comes out of vogue, folks are going to jump back into equities. But if fixed income remains in vogue, like we see, last week, for example, because yields are so high, that could put a damper on equity returns. So we just have to wait and see. But there's also the election coming up too. So it could just be folks, basically buying fixed income to get out of the volatility of equities. And then after we get through the election, maybe we'll see a spike up in the equity side of things. For the trading tip of the week, I'll keep it short, I'll keep it sweet, but this is unbelievably important. I got this question a few days ago, and I've been thinking about it because basically the person was saying, hey, I'm new to trading. What do you recommend, I kind of buy? And I said, in a way, it doesn't matter. Clearly it does. But I said, in a way, it doesn't matter. Just buy with small bets. If you're new to trading, you're gonna make mistakes. And the topic of this week is when you're new to anything, even if you've been trading forever, but you're getting into a new asset class or a new strategy or a new style or whatever it is, start with small bets. The reason is quite simple. You will make money if you do well over time, but you will not make money if you do not do well in a short amount of time. In other words, it's easy to blow up with large bets that really, put a huge dent in your portfolio. If you make mistakes with smaller bets, you can bounce back from those. As you learn, as you gain experience, as you become more confident, then you can kind of ante up a little bit and put more weight on some of these trades that you have. But in the beginning, I can't stress enough, it's really important to start with smaller bets. I know it can be a little frustrating because if you win, you only win a little bit, but I promise logic says if you're kind of new in something, if you're not trading well, you want to lose with a small amount of money. So the quote here is from Howard Marks, who is probably the most famous distressed securities trader that I could think of. And it just, kind of came up when I was looking for quotes because he's in distressed securities, so I'm sure he's had some losers. But basically what he's saying is, quote, the concept of surviving on average is irrelevant. You have to survive every day, which means really that you have to survive on the bad days, end quote. And again, it's not about kind of the long run average return, although we do look at that, right? Really what it's about is preserving capital when you're unsure and being honest with yourself that you may not have the competence to hit these home runs every time. Even the most experienced traders that I look up to, they employ that same philosophy. So if you're getting into trading in general, or you've been trading, but you're getting maybe into a new asset class or strategy or something like that, can't stress enough, just start with the small bets. Get the wins under your belt, start to understand what's going on, start to feel more confident. You can always layer up from there. Just a quick note, I was in New York for 2 weeks at the beginning of October. I did film and record 2 what I'm calling industry insight interviews. One is with a fundamental hedge fund manager. The second is with an options trader. The point of these interviews is basically to bring Wall Street to you. These are guys in New York, full-time jobs, being traders, or I guess the options trader was his full-time job. Now he's moved into something different, which we surely talk about. Keep an eye out for these. I'm really excited about these because, again, the whole point of Accessible Alpha is to bring professional trading experience and conversation right to you. So look out for these. Can't wait to get these out. And as always, thank you for supporting the channel. If you're on YouTube, please like the video, please comment on the video, please share the video, please subscribe to the channel. They come out every Monday morning at 8 a.m. Eastern. If you're on the podcast, rate the podcast. It's unbelievably helpful, and it also helps kind of on the algorithmic side of things to become recommended to other listeners as well. We are on Spotify, we are on Apple, and finally, we do have our Discord server. Discord is a way for us to have real-time conversations throughout the week. Not only through voice in there, but text as well, which is really great. You can download it on your phone. You can download it on your computer. It's really helpful to just kind of have a community where we can all talk about this stuff. The link to join our Discord is in the description of the YouTube video. Please join it. Thank you so much. I know I went way over time yet again, but hopefully it was useful content. I look forward to seeing you next week. Have a great week. Have a happy Halloween, and I will see you in November.